please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Jindal Stainless posted a mixed bag in Q4. Their operating profits saw significant growth, though margins have come off a bit. Anurag Mantri, the CFO of the company, now joins in. Mr. Mantri, good afternoon. Thanks very much for joining in. To begin with, let's talk about your sales volume guidance. First up, for FY19, what are you looking at? What was your capacity utilization for FY18, and what's the outlook now for the coming year?
Okay, good afternoon. So if we look at sales capacity utilization, currently we are close to 100%, just below, marginally below 100%. And but as you know, most of our plants are world-class plants and made of almost European equipment. So we certain debottlenecking and very minimal capex, we can actually increase the capacity by another 20%, 15 to 20%. So what we are expecting in FY19 is the sales growth of around 15%. Should be our revenue growth is achievable in FY19, because once we do this debottlenecking during the year, so we are pretty confident that we should be able to have a sales growth of around 15% in FY19.
Okay. What about FY20 then onwards? Will your capacity continue to be a constraint? Because on account of that, your sales growth in FY19 at 15% guidance will still be less than the 25% that you know, in terms of a revenue growth in FY18. So if you could walk us through the company's plans in terms of expanding capacity from here on.
Yeah, so let me say this way. When I said FY19 is around 15%, it's what we say is the minimal achievable, depending on when we complete the debottlenecking. So there is a potential of going up then more than this percentage. And as you are rightly said, that as we are nearing to the capacity utilization, we are surely looking for a further capex expansion. Obviously, this will be subject to various approvals from the various authorities and regulatory authorities as well as the lenders. But what we are looking, but as you know, we have a huge operating leverage in our Odisha plant. So with certain minimal capex, we can actually double the capacity of our melting. So with just 400 to 500 crore capex, we have a potential to double the melting capacity from 1.1 to from 0.8 to 1.6. So let me give you the numbers like this. So we have a 0.8 million ton of the stated capacity, which we are nearing to the almost full utilization. We can, with certain debottlenecking, we can reach to a 1 or 1.1 sort of capacity utilization during FY19. And once obviously we will also firm up our plan in next 6 months time in terms of the new capex, which can actually double the capacity to almost 1.6 million ton. So in a period of, say, by FY20. So obviously I'm saying this all with, we still need to do a lot of work in terms of our various approvals and the planning. But the Odisha, as you know, there we have a huge availability of land. We have all the infrastructure ready in terms of the utilities, in terms of the roads and power, everything. So with very minimal capex, we can actually double the capacity, and we will surely looking to actively use this operating leverage. It shall have a tremendous growth in our top line.
Okay, let's talk about your margins for a bit. For Q4 and for the full year, your margins have come off a bit. What would you say are the average sustainable volumes for FY19? Margin, sorry.
See, margin in stainless steel, broadly it remains in the range of, say, 11 to 14%. I think that's what the range is going to be, because that's what generally average range. Obviously we sometimes get a higher margin, but I think on an average, as a guidance I will give you, this is going to be a margin range in terms of stainless steel, in terms of JSL overall.
Mr. Mantri, you spoke about how the company...
So in a quarter...
Go ahead.
Yeah, go ahead. So in a quarter, see, sometime the best way to look at the margin is full year basis, because stainless steel we have multiple grids of products. Also, our strategy is to right now is to penetrate markets with the more in the volumes, and especially going to the segment which we were not catering earlier. So the margin is not a focus right now, and obviously as I said, the 11 to 14% is what we will continue to maintain. But the sales growth will be very high. So in terms of, as I explained. So that will help us into have a good PAT level bottom line in terms of overall growth.
Okay. Mr. Mantri, you spoke about how with a minimal capex of 400 to 500 crore, you can increase your capacity from 0.8 million tons to 1.6 million tons. How will you fund this 400, 500 crore? What is the current debt on your books, your average borrowing costs, and your plans with respect to the debt?
See, we will mostly look, this expansion will obviously take 18 to 24 months, and our strategy is not to have increased the further debt. Our strategy, as you have been seeing, we are consistently reducing the debt. And we will not fund this from the debt. This will be funded from internal accrual, or maybe at appropriate time, if the market is there, we will look for some of the equity infusion in the company. So it will, surely that there would not be any debt in to fund this expansion, and we have a good internal accrual also. We will look at appropriate time that from the equity infusion, from the equity market, if we can partially fund this. So overall, we will not increase the leverage. So if you see, last year we have repaid almost 900 crore of debt. This year also again we are targeting to repay another 800 to 1000 crore of debt.